What's up, everyone? Welcome back to the Accounting Pod, where we go over everything accounting. I'm Anthony.
I'm Evan.
And I'm Lucas.
Today, we're going to be talking about the Enron and Arthur Andersen fraud case.
In the early 2000s, Enron went from being one of the the quickest growing corporation in America to becoming the face of corporate fraud. And Enron was given credit for transforming the energy industry and was one of the nation's top companies. Its stock price increased significantly. Executives were celebrated for their achievements, and investors believed the company was nearly unstoppable and would continue to grow.
But behind the scenes, Enron was hiding billions of dollars in debt, inflamed profits, and using complex accounting tricks to make the business look far more successful than it actually was. When the truth began to show in 2001, the company's stock price collapsed quickly. Employees lost their jobs, retirement savings, and investor confidence across the country was shaken.
This is an extremely important scandal. It exposes serious failures in corporate governance, auditing, and ethical leadership, ultimately leading to major reforms in financial regulation. One of these major reforms, as you all may know, Sarbanes-Oxley Act, changed a lot of things in the industry. In this episode, we're going to explore how the fraud worked, who was responsible, and why Enron's dramatic rise and fall still serves as one of the most important cautionary tales in business history.
All right, so we're going to start off with the background. Enron was an American energy company founded in 1985 through a merger between Houston Natural Gas and Internorth. Headquarters was in Houston, Texas, and it started as a traditional natural gas pipeline business. And then in the 1990s, Enron transformed itself into a massive energy trading company, expanding into electricity trading, natural gas trading, broadband and energy derivatives, and international infrastructure projects.
At its peak in 2000, it had reported revenue of over $100+ billion, ranked number 7 on the Fortune 500, and considered one of the most innovative companies in America. But the cracks were starting to show with rolling blackouts in its newest market in California. The heads of Enron, though, didn't seem worried. Kenneth Lay, the founder and chairman, Jeffrey Skilling, the CEO, who was known to be very aggressive on his accounting strategies, and Andrew Fastow, the CFO, who was willing to do anything when told to make the numbers look better.
Yeah, so these leaders promoted a culture that was fully focused on stock price growth and aggressive earnings targets. Obviously, these are two ways to promote manipulation and fraud within a company. Now we're going to go on to part 2, the fraud itself, and what really went wrong within Enron. So Enron relied heavily on mark-to-market accounting. This allowed them to record the estimated future profits of long-term contracts immediately, inflating earnings in the current period. Enron was able to use these tactics to show strong earnings even when no actual cash had been received, and cash flow was pretty weak in these times.
If a project later performed poorly, Enron often found ways to delay or hide them rather than recording losses on the books. And this created financial statements that looked pretty profitable, but didn't really reflect what was going on financially with the company.
These losses were primarily hidden in special purpose entities, hundreds used by Enron to move their debt off their balance sheets. A special purpose entity, also known as a special purpose vehicle, is a separate legal entity created by a sponsoring firm to isolate financial risks, manage specific assets, or undertake particular projects. These entities are designed to be bankruptcy remote, meaning their assets and liabilities remain off balance sheet to protect the parent company from risk. Enron abused the special purpose entities strictly to hold on to their losses and debt to maintain high credit ratings and keep their stock price looking good.
Yeah, so some of these SPEs were secretly controlled by Enron executives, obviously a big no no. This violated independence rules and created serious conflicts of interest within the company. As a result, Enron appeared far less risky to investors than it actually was.
Arthur Anderson was the accounting firm Enron chose to audit their financial statements. Anderson approved Enron's accounting practices despite clear red flags, and Arthur Anderson's one of the, well, I think it was the Big Five, but now it's the Big Four.
Yep.
Um, and then one of the major issues was conflict of interest. Anderson earned large consulting fees from Enron in addition to the audit fees. This situation weakened auditor independence and significantly reduced the likelihood of challenging management, even if they were heading in a downward spiral, just because they were getting paid so much.
Enron's financial disclosures were complex, confusing, and intentionally difficult to understand. Investors and analysts relied on the audited financials that they believed were clear representations, but didn't actually go over the risks or debt exposure because of the complexity. Once analysts started questioning Enron's disclosures, confidence collapsed almost instantly. Their high level management were pulling stocks while still telling their employees to keep investing under this false pretense that Enron was continuing to go up. When the investigations began, Arthur Anderson employees destroyed thousands of audit documents related to Enron. This led to obstruction of justice charges and severely damaged the firm's reputation. Arthur Anderson went from one of the big five accounting firms to effectively shutting down its audit practice. In the end of this fraud, tens of thousands of employees, both of Enron and Arthur Anderson, lost their jobs.
Yeah, and also just another point there. It's so important just to be ethical in your accounting practices and in your auditing practices, and that's shown. I mean, Arthur Anderson couldn't be trusted anymore, and they effectively fell apart, just like Lucas just said, after this scandal was uncovered. Now we're going to move into some expert point of view to help us get into different layers of the fraud and what actually happened. So, experts view Enron as a failure of ethics, leadership, and corporate governance, not just accounting mistakes. As we mentioned earlier, abuse of mark-to-market accounting allowed profits to be recorded before they were earned. And off-balance sheet entities, such as special purpose entities, like we mentioned again, hid billions in debt from investors and made things complex to understand.
Executives prioritized stock price over transparency. They only cared about the stock price going up and didn't care about employees or the people that they could be affecting in their retirement and other investments. CFO Andrew Fastow engineered deceptive partnerships, kind of hiding behind multiple layers of like connections between different companies. And like we said, the auditor independence completely collapsed because they had no kind of motivator to quote unquote snitch to management or go over management's heads since they're getting paid so much. And employees and investors suffered massive losses during the crash of Enron because everyone was invested in Enron at the time.
Due to such a critical failing in internal controls and auditing, this case ended up sparking the passage of Sarbanes-Oxley Act of 2002 and the creation of the PCAOB to oversee auditors and ensure that they're still working ethically. To this day, Enron remains one of the most studied corporate fraud cases in business history for good reason.
Yeah, I mean, Enron was a really huge fraud at a large scale. A lot of people were affected. Retirement funds were just wiped out. Employees were screwed over, and yeah, it affected a lot of people. So now we're going to move into the conclusion here about Enron. Enron still matters because it showed how corporate fraud can exist inside financial statements that look successful on the surface. The company appeared profitable, innovative, and powerful, but it was still hiding massive debt and it was fabricating its earnings.
Yeah, this case exposed weaknesses in corporate governance, auditor independence, internal controls, and executive accountability. And it proved that fraud can originate at the highest levels of management and not just from everyday employees that don't really have anything to do with the rules being made.
Enron also directly led to the Sarbanes-Oxley Act of 2002, which reshaped financial reporting standards and strengthened oversight of public companies. Enron still matters to this day as a warning against aggressive earnings manipulation and the impact that corporate greed can have on the market. It shows how complex audit accounting can be used to mislead investors, highlights the importance of ethical leadership in business, and serves as a foundational case study in accounting, finance, and business law courses. Ultimately, Enron matters because it reminds us that trust is the foundation of financial markets, and once that trust is broken, the consequences can be catastrophic.
Yeah, so I think that's a great overview of the Enron case there, but now I'd like to ask you guys some questions, just hear what you guys have to think about Enron, and just tie in some accounting principles and stuff like that to it. So, one question I got for you guys I can talk to here. Do you think a scandal like Enron could still happen today despite modern regulations, and why or why not?
I think it's unlikely, but still possible just because of all the, like you said, regulations that have been established since then and how much more information is now available everywhere, including like the internet, the news, wherever people get their financial information from. It's just so much more information, and I think it's a lot harder to manipulate, especially when you have a case like Enron that everyone goes back to, and it's like, all right, well, we can't do that.
For sure, yeah. Lucas, you got anything?
Well, I don't think we'll see another example exactly like Enron. We won't see someone doing the same mark to market and abuse that way. Enron's core failing is an ethical issue in being pushed to value profits over the actual quality of your work and ethical standards. Whenever we have an ethical issue like this, there's always an opportunity for it to be recreated. While the inclusion of the Sarbanes-Oxley Act and the creation of the PCAOB are huge steps in further regulating and potentially limiting, the core issue is the lack of ethical principles that were shown by Enron executives in their work culture. So long as we still have, so there's no real way that we're going to be getting rid of ethical issues entirely. The only thing that we can do is remain as ethical as we can and report ethical failings that we do see. So yes, I do believe that we can see another fraud case, not entirely like Enron, but due to the same issues that Enron had.
For sure, those are some great points there. I totally agree with you. That takes me into my next question. Do you guys think Enron permanently changed public trust in financial reporting? And do you think we still see effects of this today in the accounting world? I mean, in my opinion, I think it's hard to gain trust back from such a big scandal, especially when you have such an established accounting firm such as Arthur Andersen being involved in something like this. So just like to hear what you guys think on that.
Yeah, I think it affected a lot of people. Like, everyone was invested in Enron back in the early 2000s, late 1990s. And I think that having Arthur Andersen be one of the big five accounting firms, and then them also like betraying trust of the public, which is why they were even there in the first place, was to give the public correct information on companies. And so, yeah, I think a lot of that trust has been destroyed, but obviously, regulations and all that is meant to bring trust back to the system.
I'd actually counter that I don't think it had that big of an impact on trust, specifically because of the passage of Sarbanes-Oxley and the creation of the PCAOB. They created a kind of cushion where people feel confident now that this won't happen again. I mean, look at the current stock market with AI. We've absolutely exploded. We're, what, 25 years out from this issue now? I think that we've seen that while fraud cases like this will have a temporary impact on the market as a whole, largely the trust is only lost with the individual company, such as Enron going into bankruptcy or Arthur Andersen completely losing its independence because of them messing up this fraud case. The fact that this happened, though, I don't feel like has hit the market and had a reliable decrease in trust for an extended period of time. It's a shock to the system, but I don't think it had a noticeable decrease in the long run.
Yeah, that's a great point. I think we implemented a lot of good practices and strategies to help trend everything in a positive direction and learn from these mistakes. I think I'd like to go into some auditing and professional responsibility here. Just put you guys in the situation. Pretend you're an auditor for Arthur Andersen and you're auditing Enron's financials and you see something like this. How could you, as a young accountant, maintain independence when facing client pressure from Enron's executives and just facing pressure to meet earnings goals and stuff like that when they're extremely aggressive?
Well, our biggest issue as Arthur Andersen was the conflict of interest. Because we're getting the consulting fees for them in addition to our audit, we shouldn't be doing both. We shouldn't be doing both the consulting and the audit. Because then, if we have a bad audit, it looks bad on our consulting. At which point, they would want to, or Enron would want to cut us out. And we'd lose out on those consulting fees. And this is something that is stressed more so by the PCAOB of separation of, or being independent auditors means not having these connections like consulting that could lead us in one way or another on our audit opinions.
Yeah, I'm going to take a little different route and try to imagine what it would be like to be an accountant at Arthur Andersen, and you're kind of like your job is reliant, or maybe they make it seem like your job is reliant on meeting earnings goals. And I think obviously it'd be like can't really put yourself in those shoes, but under the pressure. But I think that if you just stick to what you believe in and your ethical duties, then I mean that's the only way to kind of avoid fraud is sticking to what you know to be right and not letting anything kind of cloud your judgment.
Yeah, that's a great point. I got one more question just to close us off here. If Enron teaches us one lasting lesson about accounting and business leadership, what should every future accountant remember? I think for me, I guess I can go first. Just like we just talked about, having ethics come first. Even if you're put in a tough situation like this, if you're able to keep your ethics first and just do what you know is right, I think the right thing will come out in the end, and I think it'll go better for you.
Yeah, for me, it would probably be professional skepticism. One lasting lesson is the importance of professional skepticism. Accountants and auditors must be willing to challenge management, even when pressure exists to agree, like we saw in Enron. The collapse of Arthur Andersen shows that independence isn't optional. It's essential to protecting the profession's credibility.
I think I would emphasize that there will always be another job. a lot of the accountants of Enron were faced with either meet performance standards that were highly inflated by unethical business practices or be fired. And when it comes to compromising your ethics, that shouldn't be a choice. There will be another job. Do not compromise your ethics because that is how you will doom yourself forever.
All right, that's all we got here on the podcast today. Thanks for joining us, and have a good one.